Right, let's kick off. So, morning, everybody. It's good to see so many of you joining us for our webinar. Are you prepared for FRS 102? My name's Esther Calder. I'm one of the partners at Moore Kingston Smith, and I'll be doing a bit of light chairing today. I'm sure many of you are familiar with who we are. There's lots of familiar names on the delegate list, but for those of you who are not quite so familiar with us, Moore Kingston Smith is a leading audit, tax, and advisory firm. We work with businesses across all different industries, as well as not-for-profit and private client. And we're also part of More Global, which is an international network with presence in over 100 countries, so very well positioned to service our clients' growing international needs. So FRS 102, which is the accounting standard used by most UK businesses, is having its biggest shake-up in years, really. And the changes can affect your financial metrics and also could have the ability to impact your borrowing capabilities if they're not sort of managed properly. So today, we've assembled a panel of experts to discuss the changes and what they mean for businesses going forward like yours. So we have Karen Wardell, who is client partner and also head of technical at Moore Kingston Smith. And we also have Tessa Park, who is our technical and training partner at Moore Kingston Smith. So before we get started, please do ask questions. This webinar is for you. We want you to get the most out of it as possible. Please do put your questions in the Q&A function, much easier to deal with them there. We'll try and answer as many of those questions if they've got broad relevance as we can as we go through. Any that don't get answered can be picked up by Tessa and Karen after the webinar has finished. The session is being recorded, so please do share it with your peers and colleagues who weren't able to make it today. And lastly, there will be a short feedback survey at the end of the webinar. Please do fill it out. It's really useful for helping us shape future webinars. So welcome, Karen and Tessa. Glad to see you've joined us in the live webinar. I was getting a little bit worried there. So I think we'll just sort of really, kick off with you, Tessa. I mean, I guess just to make sure everyone on the call is sort of completely up to speed with what's going on. Can you just sort of give us a little overview? What is FRS 102 and when are the changes coming into effect?
Of course. FRS 102 is the accounting standard which is used by the majority of UK businesses that don't adopt international accounting standards. And consequently, the changes are going to have a significant impact on an awful lot of UK businesses. In terms of when the changes are effective, they're effective for accounting periods beginning on or after 1st of January 2026, although they can be early adopted and some companies are choosing to do so. The main purpose of the changes is basically to align FRS 102 more closely with international financial reporting standards and therefore promote comparability.
And what are the key ones? It really is, I think that the one that I've been talking to my clients the most is about revenue recognition. I think that's the
Yes.
one that's sort of occupying people's minds. Can you sort of just talk us through the new requirements for that?
Yes, of course. I'll go through the stages to start off with, and then what I'm going to do is share a couple of little examples. It basically aligns the requirements of FRS 102 more closely with the five-step model for revenue recognition under international accounting standards. To talk through the steps in relatively plain English, step one is to identify the contract. So what have you actually agreed to do for your customer? And step two, so the contract, the agreement, it's likely to be written. In some cases, I guess it might be verbal. And then what have you actually promised to deliver under that contract? And what the standard refers to these things that you're delivering in the contract as is performance obligations. And you have to identify each obligation in the contract. What separate things have you agreed to do for the customer? The third step is working out how much you're actually going to get paid for delivering this contract. So what is the total amount of money that is going to be payable to you for delivering that contract to the customer? Step four is then splitting that price between the different things that you've agreed to provide to the customer, so the different performance obligations, using the terminology in the standard. And finally, what you do is you recognise the revenue at the point you've actually delivered each thing, which might all be at the same time, but for more complex contracts may well not be. So you could be recognising revenue at different stages of the contract. So what I'm going to do, I'm just going to share my screen, which hopefully will work okay, and go through a couple of little examples. So to start with an example which probably everybody in this webinar will recognise from real life, looking at a simple contract, which is provision of a mobile phone. So step one is, what is the contract with the customer? In this example, we've got a 24-month phone plan. And what that contains, it contains two performance obligations. The first one is the actual physical phone, the phone handset. And the second performance obligation is providing the service of being able to sort of send WhatsApp messages, make calls, surf the internet, etc., each month. The total price for the contract in this agreement is £50 per month over the 24-month plan, consequently £1,200. And what you then have to do is allocate the price based on what the actual standalone selling price of these two performance obligations would be. So let's say, for the purpose of the example, that the handset is worth £500 and the provision of the services is £700. So what you would do in this example, you would recognise £500 when the handset is actually provided to the customer, and then the £700 for the service on a monthly basis would be spread over those 12 months. And a key point to actually think about when applying the new version of FRS 102 in revenue recognition is that in some cases it's going to be more difficult to recognise revenue over time than perhaps it was under the old version of FRS 102. And I'm going to talk through a couple of those examples on the next couple of slides. In this example, the service is going to be over time. There's not actually a significant change. But for some industries, there will be some quite significant changes. Okay. Before I go through a couple of other little examples, I think another important point with revenue recognition under the new version of the standard is it's very much driven by what is actually in the contract that you have with the customer.
Brilliant.
It would be everyone can see it now. Perfect. It would be entirely possible for two companies doing exactly the same sort of thing to end up recognising revenue at different points, depending on what you've actually got in your contract. So that's something that's going to have to be looked at very carefully, is what does the contract actually say? And then what is the implication for revenue recognition? So I'm not going to talk through every example on this slide, but I want to highlight a couple of the ones where things potentially might change. And provision of software licenses is one where it does need to be looked at carefully. Under current FRS 102, usually what happens is it's spread over the licence term, regardless of what the type of the licence is. But under the new standard, there's two sorts of revenue recognition for this. It's either there's a right to use that software, or it's which is upfront, or there's a right to access it over time. So if it's a right to use it, then your revenue is accelerated compared to currently. And if it's a right to access, it will be spread and therefore not going to be recognised upfront. You need to look at things like onboarding fees, because if they've got standalone value, then they're potentially a separate performance obligation under the new version, so might be recognised earlier than has been the case under old UK GAAP. Again, with projects in stages, it very much depends on what's in the contract, but you could end up with revenue being front-loaded compared to what it is now, or potentially back-ended as well. Variable consideration is going to be an interesting one. Under current UK GAAP, it's only recognised when it's virtually certain, so often very, very late in the term of the contract. Whereas under the new version, it's going to be recognised earlier if it's highly probable that that variable consideration is going to be payable. So again, you could end up with variable consideration being recognised earlier.
So might this sort of apply to things like sort of performance-related pay, Tessa, at the end of a contract?
It might do. It would depend what's in the contract and how certain it is. So it's difficult. It's difficult to generalise, but often you will end up with variable consideration recognised earlier than would be the case as it is at present. Hardware and services bundles, I say the revenue recognition may not actually be that different, but it will depend on what the standalone value is of the hardware and the services. So that's very much an it depends in terms of what the contract actually says. And one I did want to highlight is construction contracts, because currently the percentage of completion method is usually used and revenue is recognised over time based on that percentage of completion. But under the new version, it's only going to be recognised over time if there are certain criteria, for instance, an enforceable right to payment for work which is done to date, or where the entity's performance, as say, enhances an asset that the customer controls. So, for instance, that would be a construction contract in which the customer controls the work in progress. So, for construction, again, it really depends on what's in the terms of the contract. Revenue may well be recognised later for construction companies than is currently the case. So, that needs to be looked at really carefully. Professional services is very much an it depends. And again, things like are milestones included? What are the separate performance obligations? Is there a continuous transfer of value? And is there an enforceable right to payment for work done? All of those things will need to be looked at to determine whether revenue is recognised over time or at various points in time, depending on the elements of the contract. I'm going to stop sharing my screen now.
So quite a lot to think about there, Tessa. And
Definitely.
you talked about the date which FRS 102 kicks in. Can you just sort of distinguish between the date where it fully kicks in and the sort of the transitional provisions?
The date where it fully kicks in is basically, as I say, it's first of January 2026, and there are various transitional provisions in the standard which will need to be thought about, as well as some practical expedients. Revenue. In terms of how you actually do it, there are a couple of different methods of doing it, which companies will need to have a look at what's in the standard and have a think, because it's not going to be one size fits all.
No, but we have a choice, don't we, as to whether we can fully re-represent the
Absolutely.
previous year's accounts or whether we put through an opening balance
Yes,
reserve
absolutely.
adjustment to that beginning
Absolutely.
period. So
Yeah.
I guess the point I'm trying to make is, whilst people might think if you've got a December year end that actually you don't need to really worry about it until the end of December 2026, actually you
Exactly.
do need to think about the position as at the end of
You do
December
need to think
25.
about it, and particularly if you think you might want to relook at what your contracts actually say.
Yeah, so don't leave it. If it's got a December year
Exactly.
end, don't leave it to the
Absolutely
end of
don't leave
December,
it. Yeah.
because then you're kind of a year away from having to think about, the how it would have affected things as at December 25, which obviously is
Yes.
literally round the corner.
Yeah.
And what I mean, I suppose the other big one, Tessa, is leases, isn't it? Which is sort of, I guess we've been anticipating for a while there might be some change, and it's finally come, and that's, I
Yes.
mean, pretty much going to affect everybody, isn't it? Assuming most clients are going to be leasing
Yes.
premises, for
Absolutely.
example.
Absolutely. I mean, I think it is going to affect the vast majority of companies, but say companies that have got operating leases currently that are lessees. I think a point to stress is if you're a lessor, then the changes are actually pretty minimal. But for lessees, definitely a big change. And a practical way of looking at it is going to be everything becomes a finance lease. There's no distinction for a lessee between operating leases and finance leases anymore. And the reason for bringing this model into play is because you basically had, with the old operating lease model, you had a liability which was not on the balance sheet. And that didn't really make any sense because all of the liabilities were on the balance sheet. So you can't bring the liability on the balance sheet without bringing an asset on the balance sheet. So therefore, we go to this model where you recognise the liability and then you recognise as an asset the right to use that particular asset over time. So all your leases go on the balance sheet, and you have a choice as to how you discount the liability. You can either use the interest rate implicit in the lease. No one does because it's usually very difficult to determine. Or you can use the incremental borrowing rate, or you can use the obtainable borrowing rate, which is the rate that you could obtain to basically obtain a similar form of finance. So you will recognise, I said, the liability, you will recognise the asset, and then you will depreciate that asset and recognise interest on the liability over time. It's probably worth mentioning that there are a couple of exceptions to this model, or rather exemptions. If you have a short-term lease, which is one with 12 months or less, the date of inception of the lease, then you don't have to put that on the balance sheet. And equally, you don't have to put a lease of low value items on the balance sheet. The standard doesn't actually give examples of what are low value. It suggests things that are not low value. So, for instance, plant and machinery, cars, aeroplanes. You would seriously hope an aeroplane was not going to be low value. I certainly wouldn't want to get on one that was. But it doesn't give examples of what would be low value. So a bit of judgment and common sense is going to be needed for those. So, for example, laptops, mobile phones, that's the sort of thing that might be considered to be low value. So again, you can ignore the on-balance sheet model for those.
Yeah. We had a question come in about the construction contracts, Tessa. So somebody said if the contract requires us to submit monthly applications for payment to the client for stage payments, then can we continue to use the sort of percentage completion method?
I think, honestly, that's a difficult question. It depends on what is in the contract. I mean, just going back to the sort of how you can recognise revenue over time, the three criteria which mean you can. I say the first one is, does the customer simultaneously receive and consume the benefits? I would say probably not for a construction contract. Does the customer control the asset? Again, with a construction contract, look at what's actually in the control. And is there no alternative use to the entity, but there's an enforceable right to repayment? So if you've got an enforceable right to payment for performance completed to date on that contract, then potentially, yes, you could continue to use percentage of completion. But you do have to look at what's in the contract in a lot of detail.
Yeah, yeah. So it's really going to be on a case by case
I
basis.
think it is, yes.
I think the
Yeah.
message is start
It's
reviewing
which is
your
why it's
contracts
not.
or
Yeah, it's not possible to say you are in industry X and therefore you don't need to worry about this.
no,
Yeah,
no. Yeah, so it's a case by case. Start reviewing your contracts
exactly,
early.
exactly.
So coming over to you, Karen. I mean, sort of thinking about this from a sort of more commercial, sort of practical point of view, can you give us some sort of scenarios where clients really need to be thinking about the impact that FRS 102, or the new FRS 102 changes are going to make on their accounts?
Yeah, I mean, I think you've covered a lot of detail there. There's a lot of changes in content. And we're focused on two main areas because that's what we're thinking will be affecting the majority of our clients and also businesses. And I think there's probably a lot of people there thinking, what about X? Lease accounting and revenue recognition is two main areas I think that everybody's going to be really focused on. So lease, basically with leases, very simple explanation. In addition to what's just been covered, you're going to need to consider the impact on EBITDA and interest expense. So earnings before interest, tax, depreciation, and amortization. Under old UK GAAP, as we know, it was a rent expense included in operating costs, reduced EBITDA every year directly, and no interest expense because there wasn't a liability. However, the change, it's quite simple, but its rental cost is split into now the depreciation, part of the operating cost affects EBITDA, but also interest. Effectively, EBITDA is going to be inflated. So you've got to be thinking about how this affects your financials and the look of those. You're going to need to consider the leases, the impact on the financial statement reporting. You know, what are your gearing ratios going to look like, your liquidity, any borrowing capacity? Is it going to be reduced, enhanced, and will you have the cash flow? Additionally, quite a lot of financing is already is our clients already have and businesses already have. And what about the covenants? Looking at the covenants on the financing arrangements suggest that those are looked at, considered, and actually communicated with your lenders, investors, because the assessments may be impacted. Um, but the underlying financial health of the business hasn't changed. It's the way it's being reported and the way it's being seen. And certain stakeholders, will have questions, and it could affect valuations, funding, discussions, etc. So, that's what the lens is with regards to making sure that you're having those communications early enough, but the considerations of what that's going to look like is important. With regard to revenue recognition, I
Just
mean,
sticking
sorry,
with
yeah.
the lease recognition, Karen, it might be worth just sort of, I mean, we've been thinking about this a lot, so it's sort of
Mm.
second nature to us what happens. But in terms of what actually happens, in terms of how the liability moves, how the interest expense moves, how the depreciation expense moves, how is that going to sort of change over the course of the lease?
I mean, so under the old rules, the full rent hit the EBITDA. Yeah, so it just hit the profit and loss. It was a direct hit to the profit and loss. Under the new rules, only the depreciation element. So we're going to have an asset on the balance sheet with a liability. So all leases will be finance leases. There won't be a direct hit to your profit and loss account. And the rest is going to be the interest cost on that finance lease. So EBITDA is going to be higher in the early years, going back to my inflation of EBITDA point. And in the later years, it's still going to be higher, but the total cost is lower. It's going to really affect the lens through which those accounts are being seen, because you're going to have an asset with a liability
Yeah.
that will be reducing over time. But yes, we've been talking about it a lot, and I think that's the one that people can quite easily see, because we're not going to have operating leases anymore. We're not going to have a direct hit to the profit and loss accounts. So we're going to need to be thinking about those covenants and the financing arrangements that we already had, and also what that narrative is externally. Um, Regarding revenue
Oh, no,
recognition,
we've had some questions. We've
oh,
had some
thank
questions
you.
coming, Karen, on the leases.
Oh,
So somebody said when you say low asset value, like mobiles, etc., is that just in relation to the individual unit cost, or do you have to consider actually if you bundle them all together, it might come to a substantial value, and then one might need to consider the new accounting
It's it's
statement?
it's not actually based on the individual unit cost, which is interesting. So if you have a lot of laptops, then those items are still of low value. So you potentially are still going to end up with them not on the balance sheet.
Okay, so you don't need to say I've got 100
Exactly.
laptops, therefore it's
Yeah, exactly.
£100,000. You can say
Exactly.
each individual laptop is a low cost item, therefore
Absolutely.
laptops are kind of figured out, mobiles are
Yes.
figured out. So it's really for the substantial
It's
assets.
the substantial stuff. Yes.
Yeah. Somebody said for leases, what are the options for declaration on the balance sheet for an intercompany 12-month lease, which automatically becomes renewed after 12 months unless it's cancelled? Does that need to be declared on the balance sheet or not?
I think this basically depends on what you actually think is going to happen at the term of the lease, at the start of the lease, because the lease term under both old FRS 102 and new FRS 102 is based on expectations at the start of the lease as to whether or not you're going to exercise extension options or break clauses or not. So let's say if you start on day one and you only think that lease is going to be for 12 months, then that is a short-term lease, and you're not going to extend that, then that's going to be a short-term lease at that point. Let's say that what actually happens 1 year subsequently, it's like, you know what, this is going to be a 3 year lease term, actually, because we're virtually certain to extend that lease for another 3 years. At that point, potentially it does have to go on the balance sheet.
Hmm. Hmm. And somebody's asked, what about disclosures in cash flow statements, payments for the right of use asset, movements in lease liability, interest and depreciation? Where does it go there?
Well, the depreciation, that I think, well, I mean, I've got to admit, I need to think this point through, but the depreciation is going to go where depreciation usually does. That is basically going to be in the operating
Hmm.
section. The lease payments, that's going to be in the financing section. I mean, basically, what you need to think about is it's the same as a finance lease, so it's going to match the treatment of what currently is done for finance leases.
Yeah, yeah. And another person has, we've got lots of questions. Can the
yeah.
borrowing rate remain the same throughout the life of the lease, or does it need to be reviewed and adjusted annually? That's a really good question, actually.
That is a really good question. Um, no, it doesn't. I don't think it does. I mean, there may be changes where you've got things which are actually linked to indices or rates or something like that. So it's going to depend on whether or not the payments and so forth are actually potentially going to change over time. But
Mhm.
if not, then potentially no. So
Yeah.
you work it out at the start and then it unwinds over the term of the lease.
The term of the lease, which is would normally be the case for other
For
accounting
exactly, yeah,
treatment where you've got a sort of an imputed interest rate or something.
yeah.
And somebody's made a really good point, sort of a commercial point, I guess, like presumably in a share sale of the entire share capital, the equity bridge would need to show the operating lease liabilities as an adjustment between to EBITDA, which I agree with. I mean, for me, the concept of having the rental cost in depreciation and interest is just bonkers, because for me it makes the accounts just not make as much sense as they previously did from a P&L point of view. So I would agree. I think any commercial transaction that the company is going to be doing, any investor is going to be adjusting your EBITDA and factoring in the fact that the lease costs have dropped into the interest and depreciation rather than showing as operating profit.
And I think having those reconciliations, Esther, and making sure that that narrative is really clear and communicated is key.
Yeah. And then we've got, I mean, back to sort of, I think my earlier point, Tess, which we covered sort of fairly briefly, is around restatements. A lot of people asking about other options to restate comparatives for the year to December 25. Do we need to make adjustments to the opening balance at Jan 26? So I think we just need to go in a little bit more detail about how we deal
Of
with
course,
this.
absolutely. I think the answer is basically for revenue recognition, yes, you can. You can either do full retrospective or not. So for revenue recognition, yes, you could adjust the comparatives. Leases is completely different. You're actually not allowed to adjust the comparatives to reflect the impact as regards leases. That is basically restated on day one. The comparatives are not adjusted. That's actually a difference from IFRS, where you actually could restate them if you wanted to. I don't think anyone basically did, but that was the option. But that option does not exist under FRS 102 for leases. You've got to, you cannot restate the comparatives.
Right. Okay. So slightly different treatment there between the revenue recognition changes
And
the
the leasing changes, absolutely.
changes. Yeah.
Yeah.
Okay. Right. Okay. So maybe I think we'll come back to you, Karen, just to sort of think about the more commercial impacts on the financial statements of the revenue recognition.
Yeah, I mean, with regards to, you're going to need to think about the timing of when these profits are going to be landing as well. So, with regards to what Tess has been talking about, with regards to like the revenue timing, and actually what that looks like with regards to who can vary those contracts. You know, if you've got persons in the business who do amend contracts to your standard T&Cs, and is there a requirement to have a control in place? Additionally, with regards to any incentives that you've got linked to profits, it could bring those incentives and performance measures earlier onto bonus arrangements, for example. So it could have cash flow impact quite significantly, and you will need to be looking at reforecasting and rebudgeting as well. You know, what does that look like, and does any of those need varying? Additionally, you need to be thinking if we're going to bring profit, if profits are going to increase and due to the timing of your revenue recognition, you might have earlier obligations to pay your tax, your corporate tax bill. You could fall into quarterly installment payments, for example. You know, there's these businesses who are selling, you know, to look at what they earn at looks like according to what your revenue recognition is going to be. I've already mentioned loan covenants, but negotiations with your finances and key stakeholders is going to be key. You know, so to reforecast, remap, and understand what that looks like for the future. The auditors are going to are going to be challenging as well, from a practical consideration. You know, and just to be minded about what it is they're going to be needing to see from you if there are any judgments or estimates that have been made as well.
Lots to think about. Dividends as well, I guess,
Yeah.
could be affected. Yeah.
The availability of the distributable funds, as you say, the profits. Yeah.
I mean, if you're partway through an earn-out payment, again, I suspect these things will just get adjusted back to how they were when you originally did the deal. I don't think there's going to be any windfall any windfall payments coming as a result of this. Tess, it might be worth just having a think about the impact on the disclosure requirements that the new FRS 102 changes is going to have as well.
Yes, of course. I think that there's been a number of changes to disclosure requirements, and there's a couple of things to sort of talk about here. The first one, which has actually got nothing to do with the revenue recognition and leases changes, is that Section 1A for small companies, the disclosure requirements of that are changing, and it's adding in more disclosures. And the reason for this is that originally the disclosures which were allowed to be mandated for small companies were governed by EU legislation. Since we left the EU, one of the slightly odd consequences of that is the ability for the Financial Reporting Council to mandate more disclosures for small entities. So what has actually happened is that some of the disclosures that small entities were encouraged to put in their accounts are now required. For instance, things like disclosures around going concern, that sort of thing. But also more disclosures are going to be required around related party transactions, and other matters such as share-based payments and provisions, which mean that more information will need to be provided in a small company set of accounts around these. Not a huge amount of additional disclosures have been added, but there are some, and they potentially could be quite important. Another point to stress, going back to the key changes in respect of leases and revenue recognition, is that a lot more disclosure will be required for lessees and lessors, actually, and also for in terms of revenue recognition. Lots and lots and lots of additional disclosures compared to what we've got currently. And that has a knock-on effect on Section 1A as well, because some additional disclosures will be required around leasing arrangements and revenue recognition for small companies. Nothing like as much as non-small companies will need to include in their notes, but nonetheless, it seems like a sensible thing to do. Small companies will still need to put some additional disclosure in.
Mm-hmm, mm-hmm. And Karen, coming back to you, obviously there are lots of different stakeholders that the companies need to think about. Who are the key stakeholders that FDs need to be sort of managing and thinking about in the process of these changes?
Yeah, I think well, it's two broad categories. I suppose it's not rocket science, but both internal stakeholders, but also your external stakeholders. Your external with refer to your banks and your lenders, your finance institutions, shareholders. If you've got private equity, any analysis that you work with as well, making sure that you're given the right picture and the right disclosures, and actually they're clear and understanding of your finances. Mentioned the auditors, they're going to want more information. They're going to be challenging. I mean, we speak to our clients a lot about their accounting policies, referring back to Tessa's point with regard to disclosure, looking at your revenue recognition policy, your accounting policy for income recognition, there's going to be a lot more disclosure. The auditors are going to be challenging with regards to that. HMRC, being minded of the tax authorities when your tax bills land in and what that looks like, whether you get into quarterly instalment payments. Suppliers and key commercial partners, I think, reaching out so they have an understanding of your key metrics and they're not making assumptions based on what you're going to be filing. I mean, especially for small companies, going back to what Tessa was saying, there's a lot more information in there. You're giving a lot more food for thought to those external parties. Internal stakeholders are going to be the boards, they're going to be your shareholders, but also looking at your leadership team, your senior leadership team. What is it they're going to be needing to make those key decisions, business decisions? I referred earlier when we was talking about the reconciliations, as you rightly say, Esther, it's just a different lens, a different focus, and you're going to need to be actually communicating that story. HR, remuneration committees, who deals with your salary increases at what time, any change to your revenue recognition and how you're going to be recording, your key metrics. Do we need to be looking at the bonus arrangements and the incentives, that are on offer at this moment in time? Also your internal audit, your finance teams, they've got to be on board with regards to understanding what the key changes are. But do they have the skill set to understand what it is you're asking of them? I referred earlier as well to, if you've got in construction, you've got salespeople, are they able to vary the T&Cs of your contracts? How many contracts do you have in place? And that could vary. It really is. Start thinking about this now.
Mm-hmm. Right, I'm going to pick back up on some of the questions that we've had. So somebody's asked for time-based services. Can we continue to recognise income based on time spent on client activities? I'm guessing, Tessa, you're going to say it depends, but maybe give us a scenario where it may and where it may not.
Esther, I think you absolutely read my mind. It is very much an it depends. I think it's coming back to those criteria for recognising performance obligation being satisfied over time. Is the customer receiving and consuming the benefits as the entity performs the work? Is there an asset that the customer controls? And if not, is there not an asset with alternative use to the entity? And there's an enforceable right to payment for performance completed to date. So let's say you're a professional service firm, you're doing a piece of bespoke work for somebody. If it hasn't got an alternative use to you, the professional services firm, if the work for whatever reason is stopped halfway through, and your terms and conditions give you an enforceable right to be paid for performance completed to date, then yes, you can continue to recognise revenue over time, which is again going back to it being really important to have a good look at what's actually in your contracts with your customers.
So I think in a lot of cases, it is going to probably rely quite a lot on the ability to enforce the right of payment,
I
isn't it?
think
Because
it will,
a
yes,
lot of these
absolutely.
services, like let's
Yeah,
say we're doing an audit, the
yeah.
client isn't consuming the benefit of us doing the audit over time. It's only when we sign the audit report. So
No, and the
there's a
audit
big
report
creative.
doesn't have an alternative use to us, and half an audit
No,
report
exactly.
doesn't. Yes,
Yeah.
half
So
an
if you're
audit
doing
doesn't. So
creative services for a client,
yeah,
you're doing it in the background over time, and something is delivered at the end. So I think,
yeah,
yeah, the contract terms and the right to enforce
really
payment is
important. Yeah.
really, really important. What else do we have? If a non-refundable training course paid up front is spread over 6 weeks, can it be taken as revenue at the start of the course?
That's
So
an that's an interesting question, and I think the answer is probably not. It's again, and it depends as to what's in the contract, but that is basically an upfront payment for a training course delivered over, sort of 6 training courses. Then I think at the point that let's say somebody cancels after 2 training courses, and I think at that point you could recognise the rest of it,
yeah,
but not on day one, because the expectation is you're providing that training course over that period of that training over 6 courses.
it's almost here where the consumption of the service trumps
Exactly,
the
exactly.
fact that
That's
you've got the
exactly
payment
what
in
it
the
does.
bank. Yeah,
Exactly. Yeah.
yeah. Okay, what else have we got?
There
We
was
have,
a question on turnover rents, which I don't mind answering.
yep, go for it. Yep.
Okay. In terms of turnover rents and how they work with the right of use asset on balance sheet lease liability model, when you're calculating the lease liability and consequently the right of use asset, you include variable lease payments which are based on changes in index or rate. So, for instance, a change in SONIA. You don't include variable lease payments which are based on something else, and a turnover rate is a variable lease payment which is not based on an index or rate. So consequently, you only account for that when it's actually payable.
Okay. Impact on the lessor. Have we covered that?
Minimal.
I think minimal.
Very minimal. There's some additional disclosures, and there's a couple of very tiny tweaks, which are not likely to have much practical impact. But if you are a lessor, then I'm not going to say you don't need to worry about this, but you need to worry about it a lot less. Have a look at the disclosures, have a look at the minutiae, but the actual model for lessors fundamentally is unchanged.
Mhm. Question around advertising contracts. I think this is meaning talking about sort of media buying. Would you just still recognise the income as the adverts are placed and the media is aired as one currently does predominantly under FRS 102?
That one is, I think, really difficult to answer. I mean, if that is your performance obligation, and that's what's in the contract says that that's the obligation that you've got to deliver to the customer, then I think probably yes. But again, I can't stress enough, it depends what's in the contract.
Yeah, I suppose it depends whether there's some value in the contract that's carved out for the media planning
Yeah,
piece that
exactly.
goes beyond
Are
that.
there different stages to that?
Yeah.
Is the design a separate performance obligation, and then actually delivering the advert is a separate one? It will
Yeah.
depend on the contract.
Somebody's asked, are there any pro forma accounts out there with the new disclosure requirements in them? And does the current lease disclosure note just sort of disappear?
I don't know about the pro forma accounts, but in terms of the current lease, no, yes, it will disappear unless you've basically got like short-term or low-value leases where you're taking that exemption. And if you are doing that, then you have to disclose that you've taken the exemption, and you'll still need that operating lease note for those specific short-term or low-value leases.
Mm-hmm. What is the latest date that a rental lease needs to be recorded on the balance sheet for a 31st of December year end?
You recognise it on the data on basically 1st of January 2026, if it's a December 2026 year end.
Yeah. Somebody's asked, if there are no prior adjustments, then what happens to a long-term contract that falls over 25, 26? I think we were saying there were no prior adjustments on the lease.
Yes,
that you need
there's
to,
actually it's on the
but not.
leases. It's worth mentioning a really useful practical expedient on transition. Actually, if you have a lease which has less than 12 months to run on, let's say again it's a December year end. Let's say on the 1st of January 2026, you've got say a property lease which expires in September 2026. You actually don't have to put that lease on balance sheet. You can treat it as a short-term lease, and that is actually a really useful exemption.
But so I think we're saying here that for the revenue recognition changes, that there can be prior adjustments, or there can be transitional adjustments to the opening reserve.
Yes,
Maybe touch a
absolutely.
little bit more about how one would deal with that, Tessa.
Yes, so I mean, option one, so for transitional revenue recognition, is you just apply it fully retrospectively. Option two is you still apply it retrospectively, but what you do is the cumulative effect on initial application is put through your retained earnings at the date of initial application. You do have a couple of practical expedients. So if it's fully retrospective, you don't have to restate contracts which either begin and end in the same reporting period or were actually finished by the beginning of the first comparative period you presented. And there are also a couple of others which you can take regardless of which approach you take. So if you use contracts which are complete at the end of the reporting period, there's an exemption where you can use the transaction price when you finish the contract rather than having to go back and think about variable consideration, which was happening before. And there are also some sort of practical expedients around modification of contracts. But generally, it is basically you need to think about retrospective and what you would have to do, but think about those practical expedients and which ones it might actually be useful to take.
So if you went for the fully retrospective approach, so that
Yeah.
when you file your accounts for 31st December 2026, you
Yes.
restate the comparatives
You
for
do restate the
2025.
comparatives. Yeah.
Have you then got to think about the opening position as at 1st of January 2025 as well?
Basically, yes, because if you're taking fully retrospective, then that's pretty much what it means. So it really does depend on the sort of terms and length of the contracts that you've
Yeah.
got as to whether this is really going to be an issue or not.
So if you're going for that option, that kind of just brings in a whole nother cut-off period that you
It
need to think
does.
about.
It does. I
Yeah.
mean, from IFRS adopters, most people have got a lot of people have gone for basically not full retrospective, but actually recognising a sort of catch-up adjustment on day one of applying the new requirements.
Yeah. Okay. We are pretty much near the end, so I'm going to wrap up just to ask both of you, are there any other key points that we haven't mentioned that you think will impact people listening today?
I think for me, it's the communication. Think about the communication commercially. Look at the time cost. Who it is internally that you're going to be tasking to actually consider this impact now, because it will affect. It will have an impact. So yeah, be thinking about it now and reach out to us if you need any help or assistance.
I think just from me, the only thing I would add is again, take the time to think about this, really drill down into the contracts, really drill down into the lease arrangements and have a think about what the impact is going to be. And again, as Karen has been saying, think wider. Think about the commercial implications, but there are also other things that might need to be thought about. So, an obvious one for the leases is that assets are going to go up, liabilities are going to go up, but qualification of a company as small, that the balance sheet metric for that is based on total assets, not net assets. So if you've got a lot of leases, you could end up with a situation where you might in future not be able to qualify as small with all the implications of that. So another thing just to think about if you've got a business that's on the borderline that's got a lot of leases.
Hopefully, maybe the increases in the cut-off for small
That
and medium might
that
help
would
out there.
potentially help, absolutely. But
Changing company
Yeah.
sizes, yes.
yeah.
Well, super. Thank you both very, very much. There's lots for everyone to think about there and lots of useful hints and tips. I'm sure everyone's going to be going away and doing some calculations on their leases and their revenue recognition to see what impact it's going to have on their account. So thank you very much. There are a few questions there that we didn't get around to answering, but we'll do those separately as a follow-up. So thank you very much. Enjoy the rest of your day and don't forget to fill out the feedback form. Thank you very much.